In this video, I'll be revealing why retirees with less than $500,000 are retiring before you and how this counterintuitive reality exposes the biggest mistakes that most high earners and disciplined savers make in retirement planning. And we're talking about the silent majority of high net worth accumulators, the engineers, the doctors, the executives. Look, you're financially ready to retire, but you're still chained to your desk. And meanwhile, people with $500,000 or less are pulling the ripcord and living their best life already. The truth is, the problem isn't how much you have saved. It's how you plan to use it, and more importantly, the psychological head trash that you've accumulated along the way. Through working with clients across all levels of wealth, I've discovered that clarity and strategy often matter more than raw accumulation for achieving real retirement freedom. And that's why I'm making this video today, to show you why the problem isn't your portfolio size, but oftentimes your mindset, and how you can learn from other retirees who have already started. Let's get right on into it. The number one thing that keeps high earners and disciplined savers stuck is their addiction to certainty. Look, you don't build a massive portfolio by accident. You did it through discipline, hard work, and a constant need to be right. You're excellent at your job, and you expect the same perfection in your retirement plan, as you should. For someone like yourself, anything less than 99% success score feels like a personal failure. You run the numbers, and your planner tells you, hey, you're at a 90% probability of success. What's your immediate thought? I can't retire, or I need to get that score up as high as possible so I can feel comfortable doing so. That 9% gap becomes the perfect excuse to stay stuck in what I call the one more year trap. But here's the thing. A lot of retirees are confused by what that success score actually means. In fact, I've even heard advisors use the analogy completely wrong. They may say something like this. If you just boarded an airplane and the pilot comes on the speaker and says, we have a 90% chance of making it there today, folks, would you stay on the plane? Well, if you're like me, I certainly would not. And most people wouldn't board an aircraft that had a 10% chance of certain death. However, that's not how the Monte Carlo works. It simply means there's a chance you'll need to make an adjustment. So rather than a 10% chance of crashing, you can have a 10% chance that you land, 5 minutes later than expected. To put this in retirement terms, there's not a 10% chance of running out of money and being on the street, but there's a 10% chance you'll need to make an adjustment, which typically looks like spending a little bit less in a few years. For example, rather than spending $10,000 a month you were planning to spend, it might need to be $9,000 a month for a year or two. But look, life is not certain, and retirement is certainly not certain either. You're waiting for a guarantee that will never come, and most often, people are sacrificing your best years for it. Compare that to the person that's retiring with $500,000 or less. More often than not, they won't have the luxury of obsessing over a 99% success score because it likely won't come. However, they are forced to accept the reality that life is flexible and they need their retirement plan to do the same. Their plan might show something like an 80% success rate, and they're fine with it. The reason why is because they know something that the high earner forgets, that they can adapt. Many of these people know that if the market takes a dive, they can cut back on discretionary spending, and they know they can pick up a part-time job for a year or two. They know that they can change their plan, and they are emotionally ready to be flexible. Of course, that scenario isn't desirable for everybody, and for the high earner, it oftentimes isn't even a reality. But more often than not, they're terrified of the idea of ever even having to cut back. They're terrified of being wrong, and they're terrified of the Monte Carlo score dropping, even if it doesn't mean failure. So here's how you fix it. You need to shift your focus. The goal shouldn't be a 99% success score. Your goal should be building a plan that you are confident can actually withstand adversity and change. And that confidence comes from knowing that you can adapt by utilizing a margin of safety, not from accumulating an extra $1 million or working a few more years that you just won't need or won't even spend anyway. See, the best plan is one that is flexible, not the one that is flawless. Ask yourself this: am I waiting for certainty, or am I actually ready to adapt? And if you're waiting for certainty, you're on track to retire later than you probably want to. The second massive psychological barrier for high earners and diligent savers is the identity crisis that comes from leaving your career. See, for decades, your job title was your shield. It was your status. It's who you are. And when you answer that question, who are you? Well, for many people, you were the vice president, the senior engineer, the doctor. You get it. That title became, for a lot of people, a large part of their identity. And how can it not? But for most people, when they pull their retirement ripcord, that title was gone. You're just John. You're just Sarah. You're just you. And for many high achievers, the fear of losing status, the fear of being just you, is oftentimes just as great, if not greater, than the fear of running out of money. In fact, that's not really even as much in play because they're terrified of losing the meaning, the structure, and the importance that work provided for so long. And if we're being honest, this is why many people run from a job they hate, but they have nothing to run to. See, they fall in the classic trap of retiring from something, not retiring to what comes next. So in order to fix this, you need to get granular about what you're retiring to. The most prepared retirees that I work with can describe exactly what they want to be doing on Tuesday mornings at 10 a.m. 3 months into retirement. And if that sounds crazy to you, or you have no idea what that could even look like, well, you might not be as ready as you think you are. In fact, you've only solved the money problem and not the meaning problem, which might be actually the thing that's keeping you stuck. Retirement numbers are important, but too often purpose gets put on the back burner. But there may be some people that say, I want to keep working so I can give my kids more money. And while I commend that approach, no one's going to visit you on your deathbed and say, darn it, I wish my inheritance was just a couple $100,000 bigger. I wish you would have worked a couple more years. Instead, they'll remember the time that you spent with them, and they will remember the things that you did together. But in order for all this to work, you must solve the identity crisis by building a new post-career identity that is more compelling than the one that you're leaving behind. And if you're running from something, you'll quickly find that you brought yourself and all of your unhappiness into retirement with you, and that is not a retirement that anybody wants to live. So if you're ready to retire on purpose and optimize your retirement plan so you can confidently pull the retirement ripcord, click the link below and book a call with me, and I'd be happy to chat. But let's talk about the third major mistake, which is confusing accumulation with more clarity. Many people focus on the wrong number. They focus on the balance, the $5 million, the $10 million saved because, well, it sounds safe. But they have no idea how much they can actually spend and what all that money actually translates to. Because the reality is this. I talk to many people in this position that have never tracked a budget because my checking account just always seems to go up. See, that works fine when you're in accumulation phase, but in retirement, when you see that amount of money start to go down, you need a plan. And you need to know that the plan works not just for early years in retirement, but for the rest of your retirement. But it doesn't have to be complicated. In fact, it could be even simple. This is where the 3-tier spending framework comes in, and it can give you the confidence you need to retire and understand your spending. We break it down into 3 different levels. First is level 1, or your baseline spending. This is the absolute minimum that you need to keep the lights on, your mortgage, your utilities, food, etc. This is the basics. Think of it as your anchor. If the market crashes or goes down, you know that you can cut back to this number of spending and survive. Level 2 is your desired spend. This is the sweet spot. This is truly what you're planning to spend in retirement. It's the amount that you need to feel reasonably confident and happy, not just in the beginning of retirement to be able to spend, but as things goes on. It includes all the things that you need, but also all the things that you want. This is the number that you need to hit to actually feel good. And lastly is your maximum spend, your desired spend. I call this the live it up number. It's the upper limit of what you can spend while still having your last dollar leave your account as they put you in the coffin. Knowing this number gives you a feeling of comfort that you're not retiring on a razor's edge and of course not spending dangerously. But in order for all this to work, you need to be honest about your spending and the assumptions for your plan. What are you putting in there for inflation and what are your estimated returns? What's your strategy for sequence of returns risk? And how are you to take all the money that you saved and withdraw it in the most tax optimal way possible? See, one bad assumption, one bad number can throw off the entire thing. But having clarity on your monthly cash flow can help create the confidence you need to retire and know that you'll be okay. It's not just about the overall size of your portfolio. Finally, let's talk about the golden handcuffs that keep most people stuck in the one more year trap. For many people, this is what keeps them stuck. You have your stock options, your RSUs, or a massive bonus that vests in 12 to 18 months. And leaving that $200,000 to $400,000 on the table is always going to feel like a financial mistake. But this is the sunk cost fallacy in its most expensive form. You become addicted to the next carrot on the stick, and well, rightfully so. It's served you well and it's helped you build your wealth, but it's now the very thing preventing you from enjoying it. Because retirees without that incentive have an easier choice to make. Their decision is often as simple as, can I cover my baseline spend with my current nest egg plus Social Security or a pension? However, your decision is more complex because it has more layers, and it's a good problem to have until it keeps you stuck mentally. because you have to actively choose to walk away from a large sum of money. It's one thing to say it, it's another thing to actually do it. But here's the truth. There will always be another carrot. And if you stay one more year for the RSUs, the company will introduce a new long-term incentive plan. If you stay for the bonus, they'll promote you and you'll have even more to lose next year. It never ends until you actually say that it does. Because there comes a point in everyone's life where you must decide when you will stop trading your time for money. Eventually, everybody does. And if you're financially ready, but you are staying for the golden handcuffs, you're choosing money over the most precious, non-renewable resource that you have, which is time. And I've never heard or met a 75-year-old who said, Kyle, I wish I'd worked 5 more years. But what I often do hear is that I wish I started that next chapter sooner. Look, many people don't have the mental hurdles to jump into retirement. Instead, they are forced to achieve clarity, adaptability, and purpose. They know their real number, they know they can adjust, and they know what they're retiring to next. But if you've been a high earner and a disciplined saver, the good news is you have the money. But oftentimes, you can be trapped by your need for perfection, your fear of losing your identity, and your addiction to accumulation. And to accelerate your own retirement timeline, you must stop chasing that arbitrary number and start building a plan based on clear lifestyle and a compelling purpose. You don't want to be the person that lets the same discipline that built their wealth now be the very thing preventing them from enjoying it. And look, you don't have to do this alone. If you're ready to get professional guidance on how to optimize your retirement strategy for both finding clarity and building the retirement that you've always wanted, then click the link down below to book a call with me, and I'd be happy to chat. Thanks so much for watching. I'm Kyle Kuyat, and I will see you next time.